The problem for first home buyers is you may be able to purchase that block now, but in 18 months' time, maybe you lose your job, which means your borrowing capacity is less, and you may not be able to get a loan to afford that.
Have you
block.
got 5%?
Yeah.
Can you go unconditional?
Yeah.
Can you afford to lose that deposit if you can't complete? There's a lot of questions you need to ask. You need to be cautious.
Yeah.
Particularly for a first time, borrowing buyer.
Matthew Burcul, otherwise known as Mate, welcome to the potty, mate.
Thanks, Lee. Great to be here.
long time listener, first time guest.
That's it, exactly.
Mate, Melbourne weather is absolutely turning it on this week. What a week to be down here. Australian Open's happening, 40-degree days. Melbourne all starts to make sense when the weather's like this.
Yeah, I think we had about 250,000 out of the tennis, and it was 45 degrees. So it's been great,
mate. It's amazing. I used to sublease a couple of Airbnbs when I was first trying to get started in business, and Australian Open was the busiest time of the year in Melbourne, which I didn't realise until I had those.
Yeah.
Yeah. Anyway, so obviously going to talk a little bit of property today. So for the people who don't know who you are, what do you do for us?
I'm a consultant with First Home Specialists, and I look after the state of Victoria with my colleagues Mario and John.
Yep. So what does your job involve?
It involves engaging with clients, making calls on a daily basis. We get leads that filter through from our different sources. I qualify our clients, have a little bit of a chat about the market, what their needs, what they require, where they want to live, what are their aspirations, hopes, and try and pull all that together and eventually sort of, move them along where we, get them to that affordability stage where we understand, what their borrowing power is, what they can, where they can actually live, and we sort of try and match up all those things. Once we've understood where they're at from a financial and affordability perspective, move them along, and then we obviously want to get in front of the clients and have a look at some different land options, look through some display homes, and try and pull it all together to get them back up to the broker to get approved with the bank.
Yeah, and what sort of things are you seeing in the Melbourne marketplace at the moment?
It's moving quickly, particularly after sort of the Christmas break. I think we sort of we got a little bit of there was definitely a spike in land values after Christmas.
Yeah.
Which and I suppose historically over the last sort of few years, Victoria sort of lagged behind a little bit. But we're really noticing, price per square metre jump up quite a bit, and availability of land is becoming a lot more scarce, which is, of course, driving the price as well.
Yep.
And the inquiry is definitely there as well. So I think with the Help to Buy scheme that came out end of December, people are aware of that, and there's a lot of clients looking for assistance and some understanding of what that looks like for them.
Yeah, we're definitely seeing that nationwide across the business. So. Yeah, it was almost laughable that the government said it was only going to make a 0.6% difference in prices. And I think what people don't realise about the property market is it's kind of in sections where you've got your affordable end of the market, which, is probably, I don't know, in Melbourne you're talking $650 to $950 is probably the lower end of the market. Then you've kind of got the mid-market, let's call that 1 to 2. I'm just making some numbers up. And then you've obviously got the high end, which is properties worth more than that. And what we've found definitely up in Queensland, we're certainly seeing the same sort of things start to happen here, is the government has brought out this Help to Buy, which I'll get you to explain a little bit afterwards. But what that's done is it's not only creating a whole heap of demand from first home buyers, like investors aren't idiots, and they've looked at it and gone, holy Jesus, there's going to be a big jump in the market here. And the thing with investors is because they're cashed up, they're quick movers. So what we're seeing, particularly in Victoria, is before the first home buyers could even get in, investors from all around the country are going, oh my God, Melbourne's a bargain. So, if you look at, we've obviously got a lot of knowledge of the Queensland market, where kind of your entry level in Queensland is 800 to a million. And I'd almost put my bottom dollar that minimum chips in Queensland's going to be $1 million by the end of the year. And then people are looking at Victoria, where what's kind of your entry price, saying the West out Truganina, Werribee, that sort of way?
Yeah, so you're looking at land in Werribee, let's say about 1,000 a square metre.
Give us actual numbers.
So let's say a 350 square metre block is somewhere around the 350 to 380,000.
Yeah,
you can generally in the West you can sort of still get something around the 750, maybe a little bit lower.
Yeah,
which if you look at compared to Southeast Queensland, that's a real bargain.
Yeah.
The further west you go, like when you head down towards sort of Lara and Geelong, you can pick up a block of land for sort of high 200s, early 300s, in an estate, which is really cheap.
You mean 200,000 or 300,000 for the block of land?
Yeah, smaller blocks, but still, fairly really affordable. You can still get a 4-bedroom home on that.
So what would your total package price be?
You can get it around the 650 to 700K down there in some of those pockets, which is really affordable.
Yeah, which is almost cheaper than anywhere else in the country when we're talking capital cities at the moment.
Absolutely.
Which means investors are pouring in and they're snapping up that land. Which what it's doing is it's raising the basement prices. So when I say basement, what I mean is the minimum chips for someone to get into the property market. So where the government's going, it's only going to move by 0.6%. I mean, we've seen 20-30% price rises in under a year already.
Yeah, the modelling that they had in place beforehand has been a little bit grey, and they haven't been forthcoming with it. And it hasn't really reflected what the market's done since the legislation.
We know you love a good government conspiracy theory as well.
I'm a big fan of all things Albo. So yeah.
All right. So talk to me more around the market and what that looks like for a first home buyer. So you're saying that there's a lot of interest there. We've definitely seen that with our inquiry. I mean, our January, I think, has been the biggest January that we've ever had on record. But how does that translate to the property market and some of the challenges that people are finding out there now that they may not have had, only 3 months ago?
Yes, I mean, we've had clients that may have come through, our channel, and they've gone up to Queensland and they've had a little bit of a look around up there, spoken to some of our consultants, and they've come back down to Victoria because the market up there is, it's 900,000 to $1 million plus for house and land.
Yeah.
So we're getting sort of that inquiry back down towards Victoria because your entry point is still around that, 750 to 800,000. The southeast is getting a bit more challenging now because of titled land, of course, and you're probably paying a premium for the southeast, and it's always been that way as well.
So what do you mean by titled land? What does that mean?
So land that you can actually build on and is ready to go. A lot of these, estates that are in the southeast, they mightn't have land that's titling or ready to build on until, the end of 2026 or, first quarter 2027. So the process to actually get into your home is at least sort of 12 months away before you can even start and break ground, and then you've probably got another 8 to 12 months before you can actually get the keys at the end of that. So that's a long hold, and a lot of people want to move into it as soon as possible, obviously.
Yeah, so I guess to put some meat on that bone for the listeners, if we're to talk in really simplistic terms, what a developer does is they essentially take a paddock and they turn that paddock into blocks that you're able to buy. And, part of that is getting your development approval, doing your civil work, so getting your roads and whatnot in. You've got to then lodge to council to get titles. And when you purchase a house in Australia, what you purchase is the title to the land, which is, it's basically just a bit of paper that says, hey, I own this. But the point of that story is that process to go from paddock to block of land that you can build on is, often 3 to 5 years. So what developers do, particularly the bigger ones, is they're trying to forecast what demand's going to be, and then they've got their construction schedule based on that. And then what happens is when we have a whole heap of demand come into the market, what people do is they buy up all of the registered land, so the titled land that's ready to be built on now. And then what happens is you're buying land which is untitled, so it's essentially still a construction site, or, in a lot of cases it's still a paddock. Yeah. So what that then means is you're not going to be able to purchase that land, so have the title transferred until a year, maybe 18 months' time. And then, like you said, you've got to build the house after that. But one of the big risks for people there is developers want you to go unconditional on that block as early as possible. So, if you get a good developer, you might get a 2 or 3 week finance period. But quite often in Victoria, if it's untitled land, they're just like, it's only unconditional contracts.
True.
So what an unconditional contract means is you are obliged to buy that block of land. And if you don't, you'll lose your deposit. The developer can sue you if they end up selling it for less, so you end up in a whole heap of trouble. Now, the problem for first home buyers is you may be able to purchase that block now, but in 18 months' time, maybe you lose your job, you get another job that pays slightly less, which means your borrowing capacity is less, and you may not be able to get a loan to afford that block.
Yeah.
It may even be that nothing changes in your world. So, you've still got the same job, same money, but interest rates go up in that time, and that reduces your borrowing down. And if you have a look at what's going on at the moment, that's a really real risk. Because the most recent inflation data came out, I think it's at 3.6%. Don't quote me on that. I think that's right, which is outside the RBA's 2 to 3% band. So, Nostradamus is saying that, you like that, Nostradamus?
Yeah, I do like that. It's very good.
I think it's almost guaranteed that unless inflation comes under control, I think at the next meeting of the RBA, we're going to see some interest rate rises. And the risk there for first home buyers is your situation doesn't change, but the market changes, and then you're not able to settle on your block. I think the other thing in that is, even if you can get an approval now, that approval will only last for 3 to 6
months.
Yeah, well, depending on the bank, 3 to 6 months, which if you've got a 12-month lead time on your block being ready, you have to get a reapproval. So this is why we're always doing our best to try and search for titled land. So a lot of people think, I saw this on realestate.com.au, I can buy it. And you're like, well, yeah, you can, but
Have you got 5%?
Yeah.
Can you go unconditional?
Yeah.
Can you afford to lose that deposit if you can't complete? There's a lot of questions you need to ask. You need to be cautious.
Yeah.
Particularly for a first time, borrower and buyer.
Yeah, 100%. So you're bringing this back around. You're saying you're seeing a lot of issues getting a hold of titled land in the southeast?
Yeah, I mean, across the board. I mean, further down, in that western corridor down towards, Mount Dunedin and places like that, there's a lot of stuff coming on board. There's a bit of stuff coming on board in the north as well, around sort of Beveridge, but the southeast is challenging, particularly around the sort of Cranbourne Junction Village area, very scarce. So a lot of the stuff I'm doing now is unconditional contracts, 5% deposit. Once you get the contract in and signed, you need to pay that deposit, and you're in an unconditional environment.
So if you were talking to a first home buyer at the moment that was wanting to get into the market, what sort of things would you tell them that they need to do in preparation to make sure they're in the best spot possible?
I think that that affordability that we spoke about. So having a good broker in your corner, which we definitely provide. Understanding the borrowing capacity, so running the numbers, through the bank's calculators to see what your repayment's going to be like and what that looks like for you. Making sure you don't apply for any credit, so no more credit cards. Don't apply for any car loans. Things like that, because all of that sort of stuff, will affect your affordability down the track. So you just need to be mindful that it's a big commitment, and especially if you're signing like an unconditional contract, if you don't complete, you lose your deposit, and that puts you so far behind the eight ball. And by the time you can sort of get back on track, the market's already moved again, and you could potentially be priced out of the market completely.
Yeah. So when you're saying credit cards and car loans, how is this affecting people's affordability?
Yeah. So if you've got a $10,000 credit card and your balance is $8,000, the bank will look at the entire amount on the credit card, and they will factor that into your serviceability calculations.
Yeah, so I think what you're saying here is if you've got a $10,000 credit card, even if your balance was zero, the bank assumes that that's already maxed out, and then they assume that you're having to make repayments on that, even though you're not having to, which then means for your servicing, which is essentially a calculation of your income versus your expenses go up.
Yeah, and we're seeing a lot of people sort of going to like a car dealership on the weekend and they walk in and they're thinking about buying a home, but they might see like a $60,000 vehicle there, a brand new car, and they can actually afford it without the home loan attached, and they get really emotionally excited about that and grab that new car. Then they come and see us a few months later wanting to get a home loan, and it's just completely changed their borrowing capacity, because those $200, $300, $400 a week repayments are now less per week than what you can actually afford on a home loan. So it's dropping your borrowing capacity down from, let's say, 700,000 or 800,000 down to 600, 650, 700,000, which is making it challenging to get into the market with the price movements we're seeing.
Yeah, for sure. And I think every dollar matters with first home buyers. So I don't think there's ever a first home buyer that we've ever met, big call, where what you want as a first home buyer and what you can actually afford are quite often two different things. And already for every first home buyer, we're kind of having to meet in the middle, where it's like, sure, you may want to live, I don't know, close to the city or something, but you need to move further out because that's all you can afford. And then you put a $300 a week car loan repayment on top of that, and all of a sudden, you may not be able to buy a house at all.
Yep.
Yeah. And I see this with a lot of our first home buyers who've got good incomes. So, you get people who are earning $150,000 a year. Sometimes we get FIFO workers. And because they've got these huge incomes, they go out and buy all the toys.
Hilux, jet skis.
Yep. And it kills their borrowing capacity. It absolutely murders it. So, yeah, I'm with you. If you're looking to get into a first home, the last thing you want to be doing is taking on that real consumer debt with depreciating assets like cars, jet skis, all that sort of jazz.
Absolutely. Like the brand new car can be put off for 12 or 18 months until you've got that home, and once you've locked that in, then you can understand where that sort of where your affordability is at, and then you can budget accordingly after it. But the number one priority is getting into the market, because it just moves so quickly.
So what do you mean by that? The number one priority is getting into the market because it moves quickly.
Yeah, look, I just think property ownership in Australia in general is a real game changer for whether it's individuals, families, whatever your situation is. You can't save quick enough to outpace the rise in values of the property market at the moment in Australia. So, if you put things off for 12, 18 months, try and save, we'll do it next year or whatever it is. You come back and properties are rising at, let's say, 8 to 10% per annum. And sometimes it's shifted so dramatically, like you look at Southeast Queensland, for example, where people are just priced out of the market altogether. Yeah. So, and once you're in, 9 times out of 10 or 95%, you just make it work.
Yeah.
But, trying to take that first step to get on the ladder is obviously the most difficult and challenging part of that process.
Yeah, for sure. I remember I had a mate of mine, Reedy, on the podcast ages ago, and he's got no background in property. I just think he's an interesting person. He probably wasn't a very relevant guest, if I'm honest. But he gave this really amazing piece of advice where he was talking about his first couple of homes, and how he was stressing out about the repayments. Are they going to be able to do it? And they ended up jumping in. And his advice to people was, yes, it's scary, but once you actually get in, you just find a way to make it work. And it is really, really true. Once you're in a home, I've been scared of every mortgage that I've ever taken on in my life.
Yeah.
And then you just make it work.
Yeah.
Yeah. So talk to me about some of the issues and the hurdles that you see first home buyers coming up against.
Deposit is a big one for a lot of the clients I speak to at the moment. So their response to me is, we don't have much deposit, or we might have 10 or 15 grand or even 5 grand. We know we can afford it because we're paying rent, et cetera, but something always pops up. And if you've got double income, a couple of kids, school fees, someone gets sick, someone breaks their arm, whatever it is, there's always something. Family members need a loan, whatever it is, there's always something that will diminish your cash reserves.
Yeah.
And I'm finding that a lot more with cost of living pressures. I know we hear it all the time, but it's definitely a reality for a lot of the people that we speak to.
Yeah. I remember when I was about 30 years old, and I was poor, right? I was broke. I had no money. I'd just been living, I guess, a typical single bloke lifestyle where whatever I earned, I spent it. And yeah, I mean, at 30 years old, I think I was like maybe 40 grand in debt, nothing really to my name. And I got really interested in money because in my head, there was no difference between me and people that were wealthy, but it was like they knew something that I didn't know. So I went on this journey to try and work money out. I'm like, how are people doing this? And as part of that journey, I read this book called The Richest Man in Babylon. So The Richest Man in Babylon, terrible read. It was written in like the 1930s, but the story was based in, ancient Egypt or something. But what it had was a whole heap of short it was one long parable with a lot of short lessons on money. And probably the thing that has stuck with me most from that book, which really changed how I go about my life financially, was this principle that you pay yourself first. So what most people do is money comes in, they pay their rent, they pay their bills, they pay for school fees, someone getting sick, whatever it is. And then if there's any money left over after that, they save that money. But the problem is what we have is lifestyle creep. So you earn a little bit more, so your life gets a little bit better. Then you earn a little bit more, it gets a little bit better again. But the problem with that is there is no end to the crap you can spend money on. The more money you earn, the more people that are there ready to take it for a slightly better experience. And this principle of pay yourself first is you get money in, and the first thing that happens is you save a percentage of it. So, and the way I looked at this was, because I always used to look at my after-tax money. So, if you're earning 75 grand a year, that's roughly 1,500 a week, minus your tax, you may be getting, 1,000, 1,100 in the hand each week. And I used to look at the 1,100 as what I earned. But when I learnt this principle, I'm like, no, I'm earning 1,500 a week. So from that 1,500 a week, I began at 10%. 10% of that goes into my forever fund. Yeah. So that's not money for me ever to spend. It's just money that I put away. And then, after that, you spend money on whatever else you need for your life. And by doing that, what it did was it forced me not only to save, but also to realize that money that I was putting away, it wasn't rainy day money. It was my forever investment fund. And it's the same as when you move into a house and you get a mortgage, you work it out. It was the same for me with that, where initially I'm like, oh God, how am I going to have enough money to live? But you work it out as long as you're within the constraints. But yeah, that principle of pay yourself first completely changed how I dealt with money and meant that I was able to not only earn it, I was able to keep it as well. Anyway, just a quick sidebar. So when we're talking about deposits, there's quite a lot of government grants going on at the moment, which can assist people with that. So what are some of the things that are in the marketplace for first home buyers when it comes to getting into a home with a lower deposit?
Yeah, so the one that we've been sort of utilising for quite some time now is the 5% deposit,
Yep.
whereby if you build a home under 750K, which is becoming more challenging, you get the 10K first homeowners grant down in Victoria.
Yep.
I think it's different in Queensland. I think it's 30K.
That's all right. Let's
quote
just
me.
talk to
Yeah.
Victoria.
Yeah, you also get lender's mortgage insurance waived, which is a huge saving. Can be up to sort of, $30,000, something in that realm. And then you also get stamp duty waived.
Yeah.
So that's a huge saving across the board, where historically you might have needed to have saved, 10 or 20% plus the costs associated with purchasing that first home. So now you get a huge reduction in that initial outlay, which is huge for first-time borrowers.
Yeah, so a lot of people think that all you need is your 5% deposit. So if you were buying, say, an $800,000 property, you need $40,000.
Yep.
But what people forget is you don't just need the $40,000. You've also got to pay lender's mortgage insurance. So what is lender's mortgage insurance?
Lender's mortgage insurance is essentially an insurance premium to protect the bank's risk against you defaulting, because the bank historically would like a 20% deposit. So if you don't have that 20%, you can only, come up with 5%. There is a risk associated with that, because your LVR is a lot higher. Your loan to value ratio is a lot higher. So the bank wants to make sure they're covered, and you pay a premium to ensure that additional money that the bank is lending in case of defaulting. Essentially,
So you pay money to the bank for them to get insurance on the loan, and then if you default, the bank gets paid out, not you.
essentially, yes.
Yep.
Yeah.
And that might be 30 or 40 grand on an $800,000 property.
It's a huge outlay.
Yeah, plus you've got stamp duty on top of that. Let's call it, I don't know, we'll call it 10 grand just for the purpose of this.
Yeah.
So you need your $40,000 deposit, plus you need your, we'll call it $40,000 lender's mortgage insurance.
Yep.
That number's not right, but back of the envelope.
Yep.
Plus your $10,000 stamp duty. So all of a sudden, instead of needing 40 grand, you'd need 90 grand.
Which is huge.
Yeah.
And there's not many people I speak to with that kind of money saved up.
Yeah.
And that's just the times at the moment. People are concerned about being able to save quick enough.
Absolutely. And then there was, Finder did some research on this a little while ago. So this research would be old, and that would mean I think the times would have blown out even more. But basically what they were saying, for someone to save up a deposit, a first home buyer, it was taking on average between 7 and 12 years to save a deposit. But the issue is the property market is doubling every 7 to 12 years.
Yeah.
So by the time you've saved the deposit for the house you want, house prices have doubled. So now you don't need double the deposit, but close enough too.
Yeah.
And it's like this self-perpetuating thing where it's like, how the hell do I get out of this? And things like that LMI waiver program help. The government's also recently come out with the Help to Buy scheme.
Yeah.
So how does the Help to Buy scheme work?
So the Help to Buy was designed for people to get into the market that were essentially really struggling to get in with certain income restrictions. So for a couple, you can earn under $160,000 per year. You can't have owned a home before or can't own a home physically at the time of the transaction, and you can get into a home with the 2% deposit. If you're a single applicant, the income's under $100,000, and if you're a single mum or dad, the income threshold is $160K as well.
Yeah. So with the Help to Buy scheme, what the government does is they take a stake in your property.
Yep.
So you own, for a new property, you own 60% of it, and the government takes a 40% stake in the property. Now, with that 40% stake, you can pay that out at any time. So, if the property goes up in value, you can refinance them out. If you sell the property, they obviously take some of the uplift. But the real benefit to that is, we'll call it $1 million property just to make my maths easy, because I'm not that clever. Yeah. So if you're looking to get into $1 million property, for example's sake, you only need to service for a $600,000 loan, which means you're able to get into the property market at a lower servicing value, which is a complete game changer because it's not just deposits people are struggling with now. They can't actually service for a big enough loan to get into the house. Yep. And this more recently is what has driven a whole heap of demand in the first home buyer section of the market.
Yep. I think there are about 10,000 places in that scheme. And there's not really too much visibility around how many have applied as of yet. It's a very new thing that's been rolled out as of December last year.
Yeah.
So we're just sort of feeling our way through it, but the demand is definitely there for that product.
Oh man, there's been huge demand. So unless this has changed recently, I think it's only Bank of Australia and CBA that are taking applications for it. And I think CBA actually came out and said, hey, we're not doing any more pre-approvals on this. It's too much work. Either you've got a contract and we'll try and get you approved. Otherwise, please stop knocking on the door. Because that many people were coming in that it was even breaking the backbone of CBA's infrastructure to try and get all of these pre-approvals done.
Yeah.
So for clients who were looking to get onto that scheme, what sort of advice would you give them?
Look, I just feel the 2% is a very achievable target. So that's probably your number one thing. Make sure you've got your 2%.
So if we're talking like a $900,000 property, we're looking at 18,000 is what you need to have.
20K. Yeah. Yep. So I think the cap in Victoria is 950,000 for where you can go to.
Yep. So that's your maximum purchase price for your property.
And I suppose the thing that I've found with a few clients is they sort of want to max that out as well, or as max. You've still got to remember that you are essentially in a partnership with both the bank and with the government. Yeah. So it's not just about the mortgage. You've still got to extinguish the debt or the equity position of the government on the way out as well. So you just need to keep that in mind. So I would imagine for most people it would be something like, take that mortgage over, 25 or 30 years, pay the bank out initially, then potentially refinance, unlock some of that equity and then extinguish the debt with the government. But they're going to take the upside on the way out. So if they put 40% of $1 million, let's say your numbers of 400,000, if you sell that property for $2 million 20 years later, they're going to take $800,000 on the way out.
Yeah, and I hear, look, a lot of people understandably are sort of like, I'm not sure I want to take it easy Albanese owning part of my property. But I think my view on that is 60% of something is a lot better than 0% of nothing, or 100% of nothing, I should say.
Yeah, because people's income and borrowing capacity a lot of the times is fixed. So, they can only borrow and afford to pay back so much. And for a lot of our clients, the reality is that's not going to change anytime soon. So again, we go back to that old adage of you've just got to get into the market any way you can. And if you can utilise those government programs and schemes that have come out to your advantage, and they are in the government is looking at it like we really want to help these people, but we're going to take our equity on the way out still. But it does give people a chance to get into a property that they couldn't necessarily afford with a much lower repayment and a much lower mortgage with the bank.
I think something to bear in mind here as well is, I mean, I've been in this industry for too long now, but the whole time I've been in this industry, everyone's spoken about the property market crash. I'm going to wait till property prices drop. But if you think the government is taking a huge stake in all of these properties all over the country, the likelihood of them allowing through policy property prices to drop is very, very low. And you take that in conjunction with the history over the last 40 or 50 years of property prices where we've never really seen them come back, particularly at the lower end of the market. So you start talking places in Toorak that are worth, I don't know, $20 million. Sure, you're going to get some movement there because it's a very small buyer base. But if the property market is a pyramid, so at the top we've got super expensive properties, low demand for those properties. when you look at the bottom end of the property market, so your more affordable properties, there is always huge demand for those, because it doesn't matter what happens in the property market, you've always got first home buyers who are trying to get in. So the other thing that you've got to remember is people who are further up on the pyramid. So if I'm in a $2 million property, for example, and I get into financial trouble, sure, I may sell that property, but then what I'm going to do is I'm going to move down the pyramid and buy something more affordable. So what it means is at the affordable end, people always want property. And what that means for property prices is you may see the growth slow down a little bit. You may see stagnation, which I think we've seen in the Melbourne market over the last couple of years. When Melbourne, post-COVID, Melbourne got into a lot of financial trouble. So you saw the property market stagnate. But when people talk about the property market crash, the affordable level of Melbourne, that is literally a crash that you've seen over the last couple of years. And that crash isn't going to last forever. But I think this is just a very long-winded way of saying that the affordable end of the market never really goes down. The best thing you can hope for is a leveling out of property prices, and even that's reasonably rare. Normally they're still going up, they're just going up more slowly.
Yeah, and you know, we always talk about people waiting for the crash or waiting for markets to pull back. And look, if you time it perfectly, occasionally you'll grab something that may have, you know, lost a little bit of value, but the rebound historically within the Australian property market is extremely strong. So yes, it might go back for, you know, 12 or 18 months, but it certainly shifts very quickly because the demand is always there. There's only so much supply. There's only so many areas on the eastern seaboard or over in WA or, you know, whatever that people want to live in.
Yeah.
So it's just the reality of the supply and demand issues that Australia faces.
Yeah, so when you're talking about macro property prices, so median house price, I definitely agree with you. And if you look at this on a chart, what you'll see is, let's say this isn't necessarily correct, but let's say the property market doubles every 8 years. Mm-hmm. That actual doubling of property prices you will see happen over like a 3 or 4 year period. And then, so the property market jumps up, it doubles, and then the median will go down a little bit the next year. And then the year after that, you often have a rebound, and then it sort of trundles along.
Flatlines a bit.
Yeah, and then goes up again. But I would suggest that if you looked at the affordable end of the property market, you don't get that drop back. You just get stagnation.
Less volatility at the bottom end of the market, absolutely.
Yeah, because it's supply and demand, and that end of the property market always has demand.
Yep.
So what are some of the fears that you're hearing from clients that you're talking to in the Melbourne property market at the moment?
I mean, I'm really bullish about the market in general. I think Victoria is undervalued, and I think that's probably a little bit of a COVID sort of era hangover with the way things have been down here, because it was a very different landscape in Victoria as opposed to other states in Australia. A lot of people are concerned about interest rates is probably the main driver, repayments.
Yep.
What can we afford? They know they need to get in, but there's still that mental hurdle of taking that first step. But, you know, the feedback I get from most of my clients sort of, you know, we've been put in homes over the last sort of, you know, at least couple of years. It's generally the best thing they've ever done. So it's just that mental hurdle of, you know, can I do it? Can I afford it? What'll happen here? All those questions that sort of, you know, float around and fears that float around our clients' heads. That's what's really holding them back. But like we said before, the reality is once you're in, you just make the adjustments accordingly, and anyone can do it as long as they sort of you know, basically put their mind to it and say, right, I'm going to do it. Let's you know, let's get in.
I think something that you talk about there with the emotional feeling that doesn't make sense. The feeling you get when you own your own home, I think it's something really difficult to describe to people that haven't owned their own home before. So I know you've got your own place just up the road here.
Yeah. So
tell me, when you first walked into it, what's some of the differences that you've experienced owning a home as opposed to renting it?
I'm going to Bunnings a lot more than I used to, and I never thought I would ever be that guy. And
I can see you there in your pluggers with the democracy sausage.
I never thought I'd be that guy, and it's a very different lifestyle and weekend to what it used to be when I was a lot younger. Getting up early, having a cup of coffee, going down to Bunnings, buying whatever it is, plants or what, and actually doing things around the house because it's yours.
Yeah.
And there's something very satisfying about that.
Yeah.
And you kind of step back and you admire your work and you call everybody over and you want them to have a look at what you've done. It's just very different. Like a rental property's great because it's a little bit cheaper, but it's not yours. You can't do anything with it,
Yeah.
And eventually you got to sort of, make your own mark and have a little bit of dirt in Australia that's your own, and it just changes your mindset with everything. You take a lot more pride in things. It's yours, so you want to look after it and make it better. Yeah. And I have that conversation with a lot of people that have bought property over the years. Like it's a massive commitment. Like outside of getting married and having kids, for a lot of people, it's a really big thing, and it is. But
it's a really big achievement, is what I say. So you're right. Some of the biggest, adulting milestones that you hear is, getting married. I've never done that. I hear it's a milestone.
Me neither. So.
Having kids, never done that either. But I hear it's a big milestone.
Got that one.
And then I think, almost directly behind that is owning your own home. And that pride of ownership, like having people around to your castle, I think it's huge, and I think it's really difficult to put a monetary value on that. But I also think that and you spoke to this a little bit, where you're thinking more long term.
Yep.
So I remember when I was in rentals, something would go wrong, you're like, landlord will fix it. Where when I moved into my own place, something would go wrong and I'd go to walk past and I'm like, hold on a second, this is mine. And you take a lot of pride of ownership in what you're doing. But I think the biggest thing that changed for me was the long-term thinking. So in a rental, you pretend it's your house, but periodically...
And that can change very quickly as well.
Yeah, exactly. Rents go up, random inspections where you've got randoms going through your stuff. The landlord decides to sell it, and you've got to have loads of randoms in your house going through your things. You might get evicted, and it happens from time to time where kind of the lie that you've been living, that this is your own home, gets shattered, and you're just stuck with this unstable and really unknown future, where when it's your own home, you don't have that. And that emotional feeling, like if I could package that up in a bundle and give it to them and say, hey, this is what we're trying to get you. I think if people could feel that before they'd got it, I think so many more people would get over their fears and make that jump. But yeah, it's something you can't really describe. It's something that you've got to experience.
Yeah, 100%. 100%. And touching on the topic of rents as well, rents have gone up by about 35-36% since 2022, which is a huge jump. So the difference for a lot of clients that we're seeing now between what they're paying in rent, which is exorbitant a lot of the time, as opposed to what they can get into from a mortgage, they're not that far away.
Yeah.
And when you show them those numbers and you sort of have a discussion with them and you say to them, well, you've been in that property for 10 years, you've paid $25,000 a year for that rental property.
Jeez, that's a cheap rental.
It is cheap. Let's say they've paid $30,000 a year. So that's, over 10 years, that's $300,000.
Yeah, that's half a home.
That is half a home.
Yeah.
Yeah.
The other thing is as well, and this starts to get a little bit mathematical, which can sometimes confuse people, but when you pay back a mortgage, you pay principal, which is paying the loan down, plus you pay interest, which is your fee for having the money from the bank. When you compare the interest bit, so interest money is dead money, just like rent money is dead money. So when you compare the rent and the interest is often cheaper. Yep. And then the principal is, whilst you have to pay that money and you can't get it back straight away. Like, it's locked up in the property. It is still your money, and it's almost like a forced savings plan.
Yeah.
And I find when you look at it like that, not only is owning a property cheaper when you remember the interest bit is the only dead money bit, plus you get all the uplift in the property over time.
Yeah. The home essentially becomes your new savings account.
Yeah.
That's how you got to look at it.
Yep.
So your equity position over time increases, and you're throwing money at that. You're not paying off somebody else's mortgage. It's just a complete game changer for anyone that gets into the market in relation to that.
So if you had one piece of advice that you could give to prospective home buyers, what would you say?
I would say sit down and write a budget and have a look at where you're really spending your money on a daily or a weekly basis.
Yeah.
And
it's the smashed Avo. Don't
it's
bring
not,
up
no,
the
no,
smashed
no, it's not smashed Avo. No, I'm the coffee guy. Like, I was drinking 2 or 3 coffees a day. It's now, let's say, $5 a coffee. It's $15 a day. So you look at that over a year. You do the numbers for me. You're the numbers guy.
50, 70, 85. It's $4,000.
Yeah,
ish, four and a half.
Okay,
grand.
so that's just one part of my life. You know, I've got the little stovetop coffee machine now, and it's like $22 for some ground coffee, and that'll last me sort of 3 to 4 weeks.
Yeah.
So just little things like that where you can make adjustments. Now, I'm not saying cut everything, all your enjoyments and pleasures out of your life, but you can look at the way you're spending money, and it's that subconscious thing where you're just tapping everywhere as well now. So it's not like you're physically going to the ATM anymore, and a lot of our clients aren't. You're just tapping everywhere, so you don't really think about it. So I think if you sort of make a list and get a bit of a budget and understanding, you can make some savings. And I think that's probably the biggest thing in my life that I've sort of changed. Just being a little bit more responsible with how I spend it, making sure that, just not being as
frivolous.
Yeah. Frivolous. Yeah, that's a word. Yeah, that's the word. So frivolous. And look, and that's how I've always been. But things, when you have a family, or you've got commitments, and you've got bills to pay and things like that, you need to be a little bit more cautious around that. And I think if you're a first-time buyer, it can definitely be done. You've just got to make a couple of sacrifices and really say, right, I'm going to do it, and take that step. And it's very achievable,
It reminds me of this bit of advice my daddy gave to me. I was at school, and I was a bit of a loose unit at school, if we're honest. And he sat me down, and he's like, Lee, you can either work hard now, or you can work hard for the rest of your life. And it's really up to you.
Yeah.
I didn't choose to work hard then. But it's the same principle when it comes to property. So you can either make a couple of sacrifices now, and the rest of your life will be comparatively very easy.
Yeah.
Or you can stay in the rental market, and it will be very difficult forever. And with this, something that people forget is, if you get a mortgage now, you are locked in at that rate. So your mortgage is $800,000. Taking interest rate changes out of it, you will always be making the same repayments. So you lock in now. Today's prices are your prices until 30 years' time.
Yeah.
However, if you stay in the rental market, rents will continue to go up by 3 to 5% every year until you're dead. Now, I don't know about you, but when I'm 73 years old, I don't still want to be scrambling around going, shit, how am I going to make the rent?
That's a terrifying proposition.
Yeah, it
If you
is.
think about that, because your income at that stage will diminish. And unless you've got a massive super balance, you probably can't afford to live in the same rental that you're living at long term. It's just a reality of your situation.
Yeah.
Yeah.
So the question is, what do you do? Like, where does it end up? And the thing that scares me is, I think for the first time in Australian history, we have a whole generation of people who will potentially be renters for the rest of their life. Like if you don't get into the market now where things are, I mean, they're closely approaching $1 million. Property prices will keep going up. You know, immigration's not going anywhere. Demand's not going anywhere. The government's doing nothing concrete to increase supply. And that's the only thing that will fix this, is increasing supply. There's this terrifying proposition that we've got a huge percentage of the population who will be renting forever. And I don't know how we handle that when that generation is 60, 70, 80 years old. But more to the point, like as an individual, like, can you imagine that? You're 75, you've got great grandkids, and you're literally still trying to make the rent.
Yeah. Like I said to you before, I think the Victorian market in general is undervalued.
Mm-hmm.
And I think with some changes this year, I think there's going to be a real run. We're already seeing investors from New South Wales and Sydney in particular, Queensland, they're here and they will drive the prices, and the affordability is still there. Like I said, you can still get a 4-bedroom, 2-bathroom, double garage, secondary living on a nice big block anywhere in the west, north, for, 650, 700, 750, 800,000. So just, yeah, I mean, the dream of home ownership in Australia is definitely not dead. And if you just make some slight adjustments, make some inquiry, you can definitely do it.
Matthew Burcul, thank you very much.
Thank you for having me.